Okay. So everybody feel free to join in because I want to take this. We talked a couple weeks ago about a few weeks ago we went through employee retention with the executive bonus plan. Then we talked about, employee retention with split dollar and had to take a little break since I was traveling last week and Jim took that one. So I want to come back to the employee retention and talk through a little bit more detail. And I think this is an area where the more creative you can be, the more options you're going to be able to give to the business owners. But I also think you're going to spot more cases. So don't get caught up, especially up front, you know, the real part of this is making sure as we get in there that we're finding what it is that the employer needs. And if you look at this, the whole part of being an employer, are you recruiting the right employees? And I think for a lot of our business owners, they think they're recruiting the right employees until they don't. And that's an area that's really more up to them. Are they effective in getting the right people? And I think the reward and retain is an area that we have to be a lot more creative. And if I came in and I said, okay, I'm gonna go hire a new person. I'm gonna hire Richard. And I enter, I let's, there again, let me back up to an experience I had. And I was my uncle up in Idaho has a plumbing business, and they install fire suppression sprinklers. So they've got two companies sit right next to each other. And I was in there, I was talking to his CFO, going over a bunch of things. And it happened to be right around lunchtime. We were in the conference room right by the front door, and a guy comes in. He's an out of work welder, and he goes and talks to the guy, and you know the guy was new in town, supposedly out of work welder. And his next comment to me was, we'll never hire him. But he said you need to talk to the shop foreman, he'll fill you in. But he said, he came back and told me, he's like, we'll never hire him. And I said, my next question was, why and how did you make such an assessment so quick? And what do you think his response was? He
Welders are
he's
out of work, and if he was a great employee, that his former employer would have never let him go.
bingo. That's exactly what he told me. He said, how would you, in this economy, there is no way a quality welder is out of work. And kind of comes back to, in most cases, when we're talking to our employers, our business owner clients, they're not, somebody's not walking in looking for a job. And for these key positions, they're out recruiting, they're out trying to find the right people. So if you think about it, to get the right person, I probably have to steal them from somebody else. And what is the laziest way to try and steal a good employee from somebody else?
Money, recognition.
I don't even think recognition hits the
Just trying
list.
to be a little diplomatic.
Yeah, throw diplomacy out of these conversations. We're too real. It's money. If I pay you more, are you going to come work for me? And the real answer is, are you going to pay me enough to walk out the door? Now, what problem do we create there? What happens when somebody wants to steal that client from me? What do they have to do?
Pay him more. Beat you.
Hey, I lost a paralegal back when I had my law firm. I paid high end wages. I got the right people. I thought I paid enough. I lost a really good paralegal because somebody else was going to pay $1 more per hour. And my first response was going to be, I'll pay you more. And before that got out of my mouth, I bit my tongue and just said, you know what? I hope it works out for you. Because I realized if they're willing to leave for $1 an hour, then either they're not the right fit or I'm doing something a little bit wrong. I just I just talked to a dentist, and this dentist, he's in the Midwest. He, for all of his employees, he pays great wages, and he also adds a benefit. First time I've ever heard a dental office doing this. They have they offer all of their employees a free massage every other week. They have a massage therapist come in. They have an office, set up for the massage therapist, and everybody gets a free massage every other week if they want it. What's the chance they're ever going to lose a good employee?
Very low.
Low. I mean, they thought out. I just thought of that, and I thought, you know what? Think about a hygienist, a dental assistant. They are on their feet or they're sitting in those, lousy chairs all day long. And here's something unique. So as you think about this, we've got to reward our people, our key employees, appropriately. And then we have to start thinking of this retention. So that's where, as we start looking at split dollar, it's, and any of these things, executive bonus, split dollar, any of these reward programs, we're looking at it. Are we dangling a good enough carrot? And that carrot that we're going to dangle has to be enticing enough based off of whatever level the employee is. If they're making $250,000 a year and we say, hey, do you want a $25,000 benefit added each year? Is that enough? Does that even move the needle for somebody that's highly compensated? Maybe, maybe not. But think about that. Then you come back and say, we also want to talk about what kind of handcuffs we can put on these plans. So if you look at this question, would you consider a meaningful benefit to employees that would also allow you to recover the costs later? Because what's the big question when we start talking employee retention? What's every employer going to ask? Is it deductible? And for if I'm the employer and it's a deduction, what does the employee have to do?
Pay tax.
They got to pay the tax. If I get a deduction, they have to pay the tax. So in an executive bonus plan, we can do that. Now, when we come to split dollar, we're going to treat this as a loan. And the reason we want to treat this as a loan is, number one, it's not tax deductible. But two, we're going to avoid treating it as income to the employee. So
win-win situation. Okay.
It can be a win-win. And here's what I like about it. As an employer, when I think about this, if I'm paying, let's say I'm paying 100,000, zeros are good in my head. So if I've got 100,000 in my checking account, and I pay that as part of a loan, now what happens is I'm going to, that 100,000 on the checking and in the checking account is on my balance sheet as an asset. Now, if I take that 100,000 and move it over as a loan and put it as a loan receivable, where does that show up now?
Still an asset.
Still an asset. So I still have the asset. I still show $100,000 of assets on my books. So I haven't reduced my assets, which could be a big thing. A lot of our employers, they're out getting financing. They need to show assets. They're construction industry. They need bonding. So they need They need assets. So we just have to be able to show them how this all, fits on their balance sheet so that they know what we're doing. So here's the thing to look at with the split dollar plan. The employee's going to own the policy. The employer's going to treat the premium payments as a loan with interest. Now, it's funny, I'll see this pop up quite a bit. And somebody will throw this out there about the new split dollar regulations, the IRS split dollar regs. And there's only a few of us on this call that I even know would probably know what it was like pre-regs. And the new regs that everybody's excited came out in 2002. So we're talking, the new regs were 23 years ago, and I still hear people talking about the new regulations. All's the and trust me, before 2002, we could do interest-free loans. And trust me, it was a great way to pull money out for our business owners, because that's what we did all the time. Now we have to treat it, basically the regulations say you can do the loan, but you have to charge interest. And if it's related party, we have to at least do the AFR rates. So we have to show a repayment of this loan. And if you think about it, and it comes down to this program has to end sometime. And this is one of those, if everybody dies when they're supposed to, it looks great. But it's like I was telling some clients the other day, I said, as long as everybody dies when they're supposed to, this is going to look good, but let's treat it as if somebody, isn't going to follow the plan. And we've got to look at it, what if they don't die? So we're going to look at it both ways. So repayment of the loan is secured by a collateral assignment. That is no different than having a mortgage on your house. So if with that collateral assignment, we've got our employer is paying money out for the key employee, what is the biggest risk for this employer? They're paying out, let's keep my example, they pay out a premium of $100,000. What's the first concern this employer has?
Well, you don't want the employee to leave.
Correct. So if the employee leaves, what I want to do is now I want a hammer. I want a hammer so I can make sure I get repaid. And that's what this collateral assignment does. It's no different than your home. You can sell your home today. And if it has a mortgage on it, you go to closing. Let's say you sell your house for $1 million. It's got a $400,000 loan against it. You sell it today for $1 million. You go to closing. How much money are you going to actually get paid?
Difference between the loan and closing costs and the equity price.
Correct. Yeah. They're going to take your loan. They're going to take that $1 million purchase price. They're going to take out all of their closing costs. Then they're going to take out what the bank is owed, and you get the net amount. There's no way to get around that, because if the bank doesn't get their money, you don't get to sell the house. Period. Same thing happens here. This collateral assignment is no different. The employee has zero control other than they get to be the owner. They get to name the beneficiary. But if there's anything owed to the employer's in first position to take that money back. And then finally, the big thing is there's no income tax deduction. So there's no income tax recognition by the employee. So this is a totally tax neutral program if we do it right. Okay.
So does you move from a stick to a hammer in this particular case? How does that vary? Or if you're going to get to it later, ignore this question, but how does this vary from the previous key employee plans that we covered, within the last month or so, as far as the stick and the carrot, or the hammer and the carrot in this case?
So if you do an executive bonus plan, the executive bonus plan is probably the simple, easy plan. It's one. So if you're Richard, if you're my key employee, I come in and say, okay, I'm going to pay 50,000 a year premium into your plan. And I will put that money in every year as long as you continue to be an employee. Now, this doesn't affect anything, if we're at will employment like we are on most of our key employees, if you violate whatever in in our employee handbook or whatever, I can still fire you. I'm not giving up that right, even though we're doing any of these plans. But if I'm in an executive bonus plan, I pay that 50,000 in, I take a deduction, you treat it as income, and we're done. Every year, we're going to keep doing that as long as I had a commitment to do it. Now, I can put a restriction on it, and a restricted executive bonus plan. The only restriction I'm putting in there is if you don't go through the whole vesting period, whether it's 3, 5, 10 years, I don't care. But if you don't vest it, you can never touch the cash value of that policy, even if you quit. So the hammer there is you decide, Rick, I don't want to work for you anymore. You leave. The hammer I have still is, hey, I got my deductions. You treated it as income. All that cash value build up in that policy, you can never touch unless I voluntarily give up the collateral assignment. And if I don't like you, I never am going to give that up. And I hope every time you look at your statement, it hurts. But with the split dollar plan, the employer is going to get repaid. Okay.
Makes sense. Thank you.
So if you look at, here's the schematic, step one, employer is going to pay the premium, treat it as a loan. The policy is going to be owned by the employee. The employee gets to name the beneficiary. That loan is going to be secured by a collateral assignment. And I get paid back before you ever get to touch anything. So let's look at this. So when I talked about it a couple weeks ago, of course, I was using a younger age. Everybody thinks about this. It's like, oh, I can't use this employee, he's too old. And so we're always thinking about, how about the young guy? Well, a lot of our key employees are older age. So let's look at somebody older age today. So now here's what I want to start looking at first. I want to look at how we're going to design this for our client. So if you come in here and start looking at what we need, what is our age? Here we're looking at somebody a little bit older. And we would look at this and say, why, if I've got a 63-year-old key employee and I'm trying to provide them benefits, number one is I realize they're a key to this business. And what is my fear with a 63-year-old in my business? Retirement. Everybody thinks we've got this magical retirement age of 65. And I'm going to, I talk to a lot of employees, they don't want to retire. Some do, but especially if they're, if they're not, I see people that are in the trades. Hey, when they're 63 to, starting to, the body's breaking down. They can't do the job anymore. But if I'm talking executive level, at 63, they may just be hitting their stride. And I'm looking at this. What if I came into this 63-year-old and said, hey, I'll put in a 7-year plan or a 10-year plan here and incentivize you to stay this extra time. And I was just talking to one of the guys that handle our ESOP planning. And Roy was telling me they just put an ESOP in place. Their CFO, she was going to retire. She was hitting that 65 mark. She was going to retire within a couple months till she realized if she stayed in the ESOP for 10 years, she'd make over $10 million. Guess what she's doing now? She is now committed to stay there 10 years. and she is excited to stay 10 years and walk out with a $10 million check. So when we go through this, of course, we've got to look at insurability. And insurability is just part of what we have to deal with. If we have 10 or more lives, then we can go into guaranteed issue. If we're under 10 lives, we're going to have to look at individual underwriting. We've got some companies now that will consider guaranteed issue at 5 lives, but it's going to still be a little tricky getting it. But if I'm doing a guaranteed issue program and I've got 10 or more lives, I can get a 63-year-old in there. And I can get, yeah.
What do you mean by you can get guaranteed issue for 5 lives, but it's tricky?
It's going to be one there. Let's be honest. They're going to have some extra, hoops that we're going to have to jump through. Because anytime you get into guaranteed issue, I mean, the insurance company is taking a leap of faith that they can spread their risk over. And if somebody in there is substandard in their insurability, that they're spreading the risk enough to be able to handle that. So just keeping, what I would say is 10 lives or more, we're good. If it's less than 10 lives, let's talk and see if we can position that in a way to get some favorable underwriting. So
Rick, do you lead? Oh, I'm sorry, go ahead.
No, go ahead.
If you were to go to 5 lives, which company would you normally work with?
For somebody that has a GI program, John Hancock would be in that space. But it's also one I can go out to the companies that don't have a guaranteed issue program. And so a North American may take it, Nationwide. They all say they're looking at building a guaranteed issue program, but sometimes if we can catch them before they get their guaranteed issue program on the books and written with all the rules, then we're getting right to the board, and they're making a business decision.
I didn't realize you were that devious.
Hey, we're not hiding anything from them. It's just how we package it.
So you are an attorney after all.
Yeah. I still have the background, so yeah.
It's called a loophole, Bob.
Yeah. It's creative planning. There's no loophole.
There you go. I know. We're just giving you a bad time. It's fun. What do you lead with this before you do a buy-sell agreement so that you can bypass a potential health issue with the owner or key man?
I usually will go in if I feel like guaranteed issue may be on the books. If we're looking at a larger buy-sell program, if I've got 10 or more shareholders, if I'm looking at this and I know the company may go into employee retention with a potential of more than 10 employees, I will tell the client, we may be able to use guaranteed issue here. Please do not tell me any health issues. If I know health issues, and this is something for everybody to hear, we are legally agents of the insurance company. And from a legal standpoint, that means if you know something, you're obligated to tell that insurance company. And so that's the legal role. When you sign a contract with an insurance company, it means full disclosure. If you know it, you're going to pass it along. But here's the reality. If I don't know, I don't have anything to pass along. And that's one where be very, don't try to straddle the line on this one. If you know it, tell the insurance company. If you don't know it, don't worry about it. Be honest. And so if I know I might be using guaranteed issue for a case, I will be very blunt with them. If you've got health issues, I don't want to hear about it.
Say, Rick,
Yeah.
If in the sale of a company, if a guy has a company he wants to sell now, would it make any sense to put a plan like this into place to keep the key employees there after the company's sold? Would the
Yeah.
buyer be interested in something like that?
I think a lot of buyers look at this because it depends on the buyer. So I'm looking at a couple companies. I'm helping on a couple companies right now that are in the sales process. One is a landscape maintenance company. And if I looked at this landscape maintenance company, the owner of the company literally runs all of the day-to-day operations of the actual business side of things. But out in the field, the installation, the maintenance and everything, he has managers and employees that he's had for 10, 15, 20 years doing those jobs. So if I was looking to buy his company, I'm going to replace everybody in the office. I already know that because they bring nothing to it, and I could probably replace them and handle that from economies of scale. But if I'm looking at this company, who do I really need? I need his field managers to stay in place because those are the hands-on people that if I try to replace them, I'm going to lose money or lose business. So if I'm going to sell this company, I look at my key employees, and if I was Bob, if you're buying the business from me, I would look at it, and one of my key selling points to you is I've locked up all of the key employees you're going to need for the next 5 to 7 years. So I walk out the door, all the key people you need to run this business and keep all of our current clients happy, they're already locked in to stay. So I think it's a huge selling point for the right employees. Now, this may be one of those where you look at it and say, hey, this CFO, I think he's a great person and should stay. But a venture capital firm would come in and say, that CFO is getting replaced because I've got somebody better. But
And then what we find sometimes too in this niche, Bob, that could even include increase the multiple by having that policy or these plans in place. It can go from 3 to 5 or 3 to 6, or from 4 to 8 or 4 to 7, I should say, probably, or 6 or 7.
Yeah, I think anytime you sell that multiple changes, if there's any certain more, the more you can provide certainty to the cash flow continuing, that multiple is going to increase. And it's the key people. But be honest, if you're looking at a sell, don't look and say, hey, I'm going to try and provide benefits and retention incentives to people I know. Yeah, you may have helped me run the business, but you're not a key component of this sale. So there might be some people with their feelings hurt. You might have to throw them a bone some other way. Okay. As you're going through this, look and make sure as we're designing this, we want to make sure we know how the interest is going to be calculated. We need to know who's going to benefit where, the employer and employee side. And if you come down here, this is the part I want to look at is when you look at, how much money am I going to put in? And that is going to change depending on what kind of carrot do I need to dangle for this person. So if I'm looking at a $50,000 a year payment, I'm probably talking somebody that's making at least $250,000 a year, and I'm adding, another 20% of their comp on top of it. How long you're going to design the plan for, that's going to be key. Now, if I look at this, remember, if I'm coming back up here and saying, hey, I've got a 63-year-old, is 10 years too much of a commitment? Or is 10 years the right number? I mean, that's going to be very specific to that individual. And, I look at this and it's, 10, maybe taking them from 63 to 70 and do a 7-year commitment. see if that works.
Rick, is this part of your intake process when you're asking these questions? Let's say, for instance, you had another business owner. He wanted to tie up some key employees, and you went and found out they really didn't want any equities. Is this part of your process as far as
This is
asking questions?
product, yeah. When I
Okay.
get into this, this is one where we're definitely not offering any equity to the key employees. But we want to lock them in. And, so as we go through this, I like looking at each individual key employee to make sure that we're hitting the right metrics for each one of them. And, because let's be honest, if I had two 63-year-old employees, I'm going to get two completely different answers in how long they plan on staying with the company. One of them may have a spouse that says, hey, you're staying 2 years and we're out. We've got enough money. We're going to travel, whatever. You've got the other one may say, hey, I can stay for the next 10 years. As long as I stay healthy, I'm happy. I want to keep working. I enjoy my job. So you want to be very, very direct here. And the other one I think is help the business owner be honest with themselves. A lot of business owners, they think their employees have the same business mentality, that they have the same drive, until they find out, no, that employee is an employee. That employee is not an owner mentality. And they're good at their job, but they don't want, you've got to make sure this is going to incentivize and not just be looked at as another entitlement. Now, when you go through, like I said, we've got to have a realistic interest rate. If they're related party, the lowest we can go on the interest rate is the FR rate. For this one, that's what we looked at, is something real close. Now, to make this work, we need to know tax rates for the employer and the employee. And then we're going to talk about is the interest going to be paid each year, or is the interest going to be accumulated inside the plan? We can capitalize the interest. The regulations say we have to account for it. It doesn't say we have to pay it every year. At least when I'm starting off here, I want to show that it's going to be paid every year. Then we can work backwards if we need to modify the plan. But here's the other one. How are we going to roll out? This is the key. There again, I said, if we know if they die, if the employee dies, we're going to get a death benefit. We're going to pay off the loan. We're going to give everything else to the beneficiary. But at some point, we've got to terminate this plan. So here I'm going to show you at the end of year 10, we're going to talk through, and this one shows we're going to have a bonus on the rollout, but we're going to look at the different options. So any questions before I go to the next page? Okay. So here's what we look at first. So when you're looking at this, we know we're going to put in that's the employer's commitment right there. $50,000 a year for 10 years. Okay. Now, when I look at this, first of all, let's look at the employer's side of this, because who's our client? The employer's our client in this case. We know that. And so this has to work for them first. If it doesn't work for the employer, there's no need to take the next step. And so if I look at this for the employer, they're going to pay the $500,000 over 10 years. That's their commitment. And if I look at that, remember, we've got a tax rate here. So if I look at this, we're going to have a net tax impact. So if I look at the actual after-tax outlay, that's what it's going to cost the employer net of all the taxes. And the tax, part of this is the employee's repaying some interest. So that's why we've got a tax impact there. So if I look at this program, the after-tax outlay, over a 10-year period, it's $424,000. So a little over 42,000 a year. That's what's the net impact to the employer's cash flow. And if they're happy with this, let's move to the next step and look at what's it going to look like for our employee. So if I look at it for the employee, they're going to get 50,000 a year in their pocket. But remember, they have to pay interest each year. So they're going to pay that interest. We're showing it at 4%, which is right at about the AFR rate right now. So if I look at this and I come down here and say, okay, now what's the impact? Well, if I look at the 10 years here, is the employee excited to see a policy with zero really cash value for 10 years?
No.
No. Why? Because if we stop and try and sell the cash value portion here, it's not going that's not the sizzle. But here's what I like. 50,000 goes in. The employee this year has paid 2,000 in interest. If he dies, his family's going to get, what is that, $462,000 of death benefit. And what did it cost the employer or the employee to do that for his family?
2,000.
$2,000.
Yeah.
What is the employer? Let's say the employee dies year one, and it's one we don't expect it to happen, but trust me, somebody's, sold a plan like this and paid a death claim in year one. What's the employer out in this situation?
Are they reimbursed for the loan?
Yeah, they got reimbursed. So
Oh yeah, nothing.
cost them nothing to put this plan in place. Did he, and it's one, if I'm an employer and this is my key employee, I can look at that and say, you know what? I helped him take care of his family.
It's a no-brainer.
If I'm the employee and look at this and say, it cost me $2,000 to get about $500,000 to my family, it's a no-brainer. Now, if I come down here and look at over the whole 10-year period, the employee now has an out-of-pocket cost of $110,000. Now, we said we've gotten to year 10. We've gotten past year 10. The employee didn't die. Now we've got to close this thing up. The employee wants to walk away. Here's our options. Option one, the employee comes back and has a loan of $500,000 and they pay, that's number one, they pay the employer $500,000. I don't care where you get the money. That is an option. Number two is what I'm showing here is we treat that as a bonus. The tax on that is $155,000 at a 31% tax rate. If you look at it, that is being paid from part of the cash value. So now I look at this and say, we rolled it out. We paid, the employee had to pay $155,000 in tax. The employer took a $500,000 loan or a deduction for the bonus that he gave the employee. And the employee paid that $155,000 of tax from the cash value of the policy. Let's stop right there. How much money is the employee really out at this point? What is
155.
How much?
The tax on the bonus.
Back up. How much really
The
came
110?
out of 110? That's what the employee's actually written. They've written checks for $110,000.
Oh, right. Okay.
For that benefit, it built up enough cash value to pay the tax on the bonus. Now, here's the sizzle that we start looking at. Is for $110,000, you're now going to generate $43,407 of tax-free income for the next, what, 20 years showing here? For $110,000, they got 860 some odd $1,000 of benefit.
I'll stand out on the corner and hand out 110 grand for 800,000.
Everybody do it. Why aren't these plans used as much? Because they're not sold the right way. If I look at this from an employer standpoint, is the employer out anything?
Oh, no.
Size time, that's it.
I mean, if you look at this, they're going to put 500,000 in. And they're going to give up time value of money on that 500,000, but they're going to benefit their key employee.
And the
At
other
the
thing
role-
too,
Go ahead.
just as far as the return on an employee, I was watching some training from Alex Hormozy and looking at another deal. One deal I was looking at, the business is making $30,000 per employee. Another physical therapist makes about $300,000 a year per therapist. So she's not in the physical therapy business. She needs to recruit more of those physical therapists. So this would allow, if they're making that amount per year, then why not go get them and retain them? So wouldn't that be part of the sale?
Yeah. I mean, you start looking at this. If I start, let's look at the pushback that we're going to have here. We're going to have a lot of employers that as we go through this, they're going to come into this and say, well, hold it. I'm already paying my employees enough. I already compensate them plenty. Okay, if that's the feedback I'm getting from the employer, then it tells me one of two things. Either one, they're too cheap and they're not going to add any more benefit here. And that there again, I'm not going to say that they're wrong either because they know their business. If I look at their tax return and they're profitable and doing a great job with their business, I'm not going to tell them they're wrong about not adding this benefit. But if they're saying, I don't want to add any more compensation to my employee, I don't need to add any more benefits like this. Okay, as long as they're taking a realistic approach, I'm okay with that answer. Number two is they may come, and I see this a lot, where they start looking at it and say, you know what? Honestly, this isn't the right person for my job, for my business.
Mm-hmm.
And they aren't a key employee. Maybe they've been a long-term employee, but they're not a key employee. And if they walked out the door, it wouldn't hurt my business. I mean, that's kind of back to when I told you about the paralegal that was walking out the door from my firm for an extra $1 an hour. I bit my tongue because I realized, you know what? I think I can replace her with somebody better. And I actually found somebody way better. And it just, I mean, I had to kind of, check my ego a little bit of, yeah, I could have paid more and kept her. But I also looked at it and said, this is an opportunity to grow my business. That's where these, some of our employers have to look at here. Now, the other part of this is, as they start looking at their business, it gives them an opportunity to say, who is key to this business? And how do I think outside the box? I go back to what most employers say. If I ask most employers what benefits they have, okay, they have a 401k. They have some kind of a health insurance plan. They start going through this and it's like, okay, yeah, but that's a belly button. Everybody's got one. So if you think your selling point is you've got a 401k, you don't have a selling point. You're just like everybody else. This is an opportunity to think outside the box and provide a benefit that nobody else is, very few people are implementing. And it gives you something a little bit more control. The other part I like about this is if I come back and say, take our employee, they leave in year 5. In year 5, I look at that and say, okay, we've put in 250,000 so far. We've got 64,000 of cash value. I've got a little bit of a lag there. But guess what? The employer could take over the policy at that point and keep it. If they've drafted the documents right and say, I'm not going to give you, the employee, you're not going to keep the policy. I can keep those.
Hey, Rick.
Yeah.
Sorry, have you ever used this as a recruiting tool if you're trying to get someone?
Yeah. Yeah. Why not? Think outside the box. If you're recruiting, think outside the box. What can I add to, what can I do that nobody else has? If you think about this, if you're going into the tech industry today and you're getting a job, more than likely, think about the tech companies. If they're public, what are they going to offer?
Stock options.
Stock options. Okay. Now you're competing against a company that can offer stock options. What are you going to do to compete against the stock options? You're either going to have to pay a lot more money or you're going to have to create
Rick?
something that gives value. Yeah.
This could work also if a key employee wanted ownership in the company and the owner didn't want to give it to him.
Yeah.
True.
And the other thing is you have a lot of these tech companies have younger children, they're W-2, they're not going to get much for college. So a lot of times it's going to come out of pocket. You might be able to offer this as a tax favorite way to pay for college, just as a benefit.
Yeah. Think about everything we do with permanent life insurance, all the benefits. Now we're just doing this using this as an incentive program, using the life insurance as the tool, as the funding tool here to make sure this works. So tax-free retirement, college planning, all of those,
Long-term care
benefits. Yeah, the long-term care benefits. I mean, everything that we would normally sell just in an individual policy, we're just using the employer as our funding vehicle, in a more efficient manner.
And Rick, too, with your employee, if that's $1,200 a month, you can get a much better person and get a much higher return on that extra $1,200 a month for $1 an hour, basically. So getting the right, if in the mortgage business, you're looking at a good processor, funder, doc drawer, closer, salesperson, manager, in an office, you're looking at a better accountant that can get returns done and do more planning in a shorter time frame. So yeah, it makes sense. I'm just thinking out
when I
loud here.
look at a good key, typically when we're talking key employees, we're talking, somewhere in the management, hierarchy probably. And so I'm looking somebody that has experience, somebody that might be a little bit older. But now I start looking at it, I'm looking at an employee that can look long term. If a lot of our employees and statistics show this, younger employees are more open to changing jobs for a bigger paycheck. Here we're looking at somebody that understands time and value. And so if I look at this and say, hey, I'm going to pay you, let's just say I'm going to hand you, an extra 50,000 a year. Well, that's good until somebody says they'll pay them 51,000 a year. Here we're saying, I'll pay you 50,000, but I need you to stay 10 years.
Hey, Rick.
Yep.
Have you ever seen this type of arrangement set up for, a key employee that's, a lot younger, maybe in their mid, late 30s? And for how long, what's the longest you've seen the agreement be set up for?
It's one here. I'll show you one that's kind of out of the box that we actually put this in place last year. And so what this company did, they come in, they have their base salary and they have their bonuses. Their base salary is stable. And their bonuses, they've got metrics and it depends on who they are. And so we were taking mid-level managers in their early 30s, and we had some upper level C-suite in this for this whole program that were in their 60s. So what they did in this case, they said we're going to take their base and we're going to times that by 50%. So think about this: if they're making 100,000, we were going to take 50,000 per year for 10 years. And in this case, what we did is we told them if you died, if there was a death in year 1 to 5, they would pay out 2 times their base salary. If they died in years 6 to 10, they'd pay out 4 times their base salary. Now, what they came out and said is they came out here and said, we're going to put a cliff vest at year 10. So if they die, the family's taken care of. But if they live, they have to stay until year 10 and they would get paid that benefit. So if they at year 10, and the documents say in year 10, within 30 days of that, they would get a check, in this case, for $500,000. But here's what they did. They also said, we're going to extend that for another 5 years with the same benefit.
Same 50,000 a year.
Same 50,000 a year. So now they took the same plan and it's really built for a 15-year max. So take somebody that was, and we had some that were early 30s. So take somebody that's 30 making just these numbers. If they stayed till age 45, they're going to get $750,000 on top of their base salary, on top of their bonuses. If they die, their family's going to get a benefit. In that case, we actually had ownership of the insurance. We changed it from a split dollar plan, and we had the ownership of the policies held by the corporation. It just worked out better that way than actually handing them policies.
Was that for tax reasons or for other reasons?
It was just to create the funding mechanism and spread the risk a little bit. In this case, there was 20, I think we ended up with 29 lives. Ages, I think we're like age 31, 32 on the low end and age 67 on the high end. And our 67-year-old wants to stay for 10 years. And in the process, now you want to think about the process. So it took 2 years to get this plan completely figured out and implemented. Originally, it started with about 35 employees in the plan. As the CEO was going around talking to all the key employees, 3 of them he fired on the spot. He just realized, he said, you know what? They're not only not the key employees he thought they were, they shouldn't even be part of the company. And
Rick,
Yeah.
you cut out there. You said originally they started out with, and that's the last thing I heard.
so they started out with 35 employees in this pool, 35 key employees. And when the CEO, he went and met with every single employee to explain the plan, what his vision was, he fired 3 people during that interview process.
He dozed them.
He just looked at it, and he never came back and came completely clean of why they didn't fit. But he realized they not only were not a good fit for his company, They definitely weren't key employees, but he just decided they should be terminated immediately. Don't ask, but he never would tell us why, but that's just how it came out. But as you start looking at this, it's be creative. You may go down the path of saying, I want to do split dollar. You may go down the path, I want to do executive bonus. Be creative and listen to the employer so you can, I mean, the nice part of the non-qualified benefits plan here.
Say, Rick, is
Yeah.
anybody else cutting out on this, or is just me?
No, we hear.
Just you.
So just
Well,
you, Bob, you're going to have to listen to the replay of this.
Wow. I'm special.
You
Oh.
are. Jim will make sure you get the link, specifically for the replay. So, but
So this is essentially a business optimization plan, and then we are just going to determine whether or not it's split dollar or executive bonus, because as you go through the process, I mean, that can be a huge swing. You talk about 3 salaries or inefficiencies that are gone. Now you can optimize, and then now you're increasing the value, increasing the profitability, making his life easier.
yeah. And it's I'll tell you, it's interesting with that company, they had over 2,000 employees. And out of 2,000 plus employees, he came down and said, 29 employees are the key employees for my business. I can replace over 1,970 employees without a problem.
This is an agricultural company in the Central Valley.
It is. And if anybody, those that know the Central Valley, can you get high quality C-suite kind of people that want to live somewhere between Fresno and LA? And
Extend that up to Sacramento from in that I-5 corridor, 99-5 corridor. Yeah.
Yeah, it's a unique area, and most people don't want to live there. And it takes the right kind of person to fit that. And that's what he was looking at is, I can replace everybody else, but these 29 employees, I cannot. So I need them to stay. And so as you look at your business owners, basically it's the questions you want to ask. Do you have key employees that if they didn't show up for work would damage your business? If it's people that you need to protect the business and get key man insurance, that's one conversation. If it's working on employee retention, let's make sure we have the right carrot. Let's make sure we have the right stick. So the carrot has to be big enough and good enough to entice them to stay. The stick is the thing that, gives the employer a little bit more control. And now we're going to design that plan to fit exactly what that employer needs for that kind of an employee. So, all right. Hey, we hit our time. If anybody has questions on this, we'll keep the conversation going. So feel free to, if you want, we can cover more questions next week. But if you have questions throughout the week, send them to Jim or me and we'll get them answered. So,
Thanks, Rick. Great information.
All right. Appreciate everybody being on.
Thanks, Rick.
All right. See ya.
Jim, Rick, I appreciate it. Thank you.
You're welcome.